Hello, everyone. This is Adil Rizvi, and I welcome you to the weekly webinar on Tuesday, the 5th of November, the Melbourne Cup Day. And we will be having a few topics to cover today. Of course, the interest rate announcement has come, which was largely expected, but we will be talking about what has been captured by Michelle in her address today, and how does that relate to the property market, and what kind of opportunities are there for people who are thinking or potentially wanting to buy a property over the next 3 to 6 months. So we will cover a lot of information today, and I'll just bring the slides up as well, if you can please bear with me. So if you are joining us live, guys, please put your comments in here, because we do these sessions specifically for you, for your questions. So if you have comments, if you have feedback, if you have suggestions, please put them in the chat. If you are watching us live, give us a hello, give us a high five. We would love to hear from you. And if you're watching a recording on YouTube or Facebook or on LinkedIn, please let us know as well. And do subscribe to our channels, because we keep sharing a lot of good, relevant content, just to give you the market insights on what's happening with the Aussie real estate. So I will just begin with the disclaimer thing at first. So let me bring it up. Okay, so here are the slides. I'm sure you guys can see it now. So at any point, if you have any questions, please let me know. And from this point onwards until the end of the month, I have opened up 7 spots for people who want to have a personal strategy done for themselves around if they want to invest in property. So book in a code with myself. The QR code is right there if you want to have a chat about your personal property strategy. There are 7 spots until the end of November. So book a call. Have a chat with myself. It's completely confidential, and we can craft your property plan right in there. So let's get started today, guys. Today we are talking about interest rates and how it is really impacting the wealth creation opportunities for the Aussies. So again, we would be beginning with the disclaimer. Like always, any information we talk about today in the webinar is of generic nature and does not take into account your personal or specific situation. It is not any kind of financial, legal, or tax advice. Please ensure to seek your independent professional advice before deciding to act on any information presented or discussed today. The information presented today may or may not be applicable to you based on your personal situation, because I'm not across that, right? So let's dive further into it. I wanted to start with the news about the inflation dropping, and this was something that was published in the 9 News last week, and this talked about how the inflation numbers have gone down. The quarterly inflation only went up by 0.2%, which was awesome. The yearly inflation went down to 2.8% for the first time. That's the target band that RBA has been talking about, but there's more to it. Once we dig deeper, there's a trimmed mean. And if you look at the trimmed mean, that is still falling outside of that 2 to 3% range. It's still higher, which essentially is because that trimmed mean does not take into account the electricity relief which was given in the September quarter. So the trimmed mean is still not there, and that's the measure that RBA looks at. But again, having said that, I think we are in the right direction. And what that actually means is that the meeting that we had by the RBA today, the interest rates stayed at a constant at 4.35%, which was largely expected. But there were some very interesting comments that were made by Michelle, and I wanted to just quickly highlight some of them. She, of course, mentioned about the trimmed mean, that it has dropped significantly in the last, since the height that we had back in 2022. But after that, she also talked about that the growth of advertised rents has slowed down more than the expectation. Now, that's a good news for the property tenants, people who are looking to rent. The advertised rents have overall across the country slowed down, which is something that we can testify to it as well, because yes, the rents are not growing at the pace that they were growing before. In some of the regional Queensland pockets, in some of the Perth pockets, in some of the Brisbane areas, the rents are not growing as fast as they were earlier, which is a good sign for the renters. For landlords, they still have opportunities, but of course, they can't expect to have rents increasing by 10% every year. That is just not sustainable, right? So that's where we are. She mentioned another important thing, which was about the availability of labor. The labor market is constrained. That's what she mentioned, and that's the key point that I want to highlight today, because that restriction or constraint of labor is really impacting the property market right now with the supply side of things. And what do I really mean over here? Let me dig a little bit deeper. Now, in this particular graph, what we are looking at is we are looking at how many people actually go into construction roles. And if you look at how the history has been in the right hand side, the left hand side graph is about how the Australian economy has been divided across different years in terms of people selecting the particular area, and in what like there were fair distribution across different segments. But once you look and compare the overall economy with the construction sector only, which is on the right hand side, that is where you see a stark contrast. People who arrived as migrants maybe 10 years or more ago, 17% of them were really opting to go into construction industry, which has now reduced down to 2.8% for the people who arrived in the last 5 years. And that is shown in this dark pink bar on the right bottom side of your screen. So what that essentially means that all those migrants who are coming into the country, which are actually increasing the population the most for the country, they are not choosing to go into construction by and large, which is creating a lot of labor shortage. And the CEO for the Stockland Group actually hinted on this terminology, and he said this is more like a pressure cooker, where the Australian real estate market can't really cope up with the increasing demand of overseas migration. Every time the migration opens up, the real estate market does not cope up with it because we don't have enough supply. So we need to get more people into the construction sector, and this is a clear reflection of that a lot of local population who's born and bred in Australia are opting for university education. They're going for universities instead of trade jobs, instead of filling the construction roles. And the people who are coming as overseas migrants, more and more people are who are actually coming as migrants are moving away from the construction based role. So that is also creating that supply issue for more trades in the construction sector, which of course is impacting, because we don't have enough trade, so we can't build new homes, right? But the migration does not stop. So the next graph, which is again the source from Australian Bureau of Statistics, talks about the migration. And even though the migration has been kind of under control pre-pandemic, but post-pandemic it has gone out of the roof. If you see in this dotted line over here, it's really high as compared to the last, well, more than 100 years. The migration is really, really high, and it has touched 560,000 people every single year. And for the last 2-3 years, it has been around 400-500K. Now, the projected forecast at this point for that migration is still quite high. So we are not stopping from getting more people into the country, but we don't have enough people to build the houses for those people coming in, right? So that's the dilemma. That's the problem we are facing. It's a real problem. It's not going anywhere. It's going to stay over here. So all those people who are sitting there on the sides thinking that once the interest rates will start dropping, I'll probably look to buy my own home, then I'll just wait. I know there are cost of living pressures, but looking at the overall dynamics, the migration is not slowing down, which means the population is growing consistently, and there's more and more competition for good established properties. Because guess what? We are not building enough new housing, and the existing people will have to rely on the existing housing only. So that's where the problem really is. Also, the dwelling approvals. If you see over here, I want to have your attention on the right hand side of the graph. Now, after 2021, if you see, the new approvals across the country has really dropped down, not just for houses, but also for units and apartments. So this red line is for houses. You see how many houses have really dropped down. It is slightly getting better. We are getting more approvals for houses, just slightly and marginally. We just need to wait and watch a little bit. But even for units and apartments, the blue dotted line, that has been dropping since 2021, which means we are not building enough new units and townhouses. We are also not building enough new houses, which means the overall dwelling values are going down, and councils are reluctant to actually approve those new dwellings because guess what? They don't. There are not enough people to work on them. The construction costs have gone up by like 40% in the last 3 to 4 years since pandemic. So the supply and demand for new housing is becoming a big problem because the demand is still there, but the supply is just not being able to cope up with it. So I just wanted to share this data, which comes from ABS once again. Also, as we were talking about the building costs going up, now this is a scenario where, as you can see, the cost to build new homes ever since from 2021, it kind of skyrocketed, and after that, from 2022 onwards, the the cost to build something versus the output prices is really going out. So that graph is really diverging, which means it is becoming more and more challenging to build new dwellings, and this is actually a testament to that. So again, this is another source which confirms that trying to build a new home right now or going into a build project, you need to do your numbers very carefully. Be very careful as to what you're getting into because the costs may blow up if you don't plan it properly. uh, Again, with the building costs going up, the other impact is a lot more companies are going bust. And if you look at this particular graph, most of the companies which are going really bust right now, major the maximum number of them are related to construction sector. Around 3000 of them actually have been busted or gone into liquidation in the last 12 months. Not a good stat, not a good picture of the economy, but it just goes to show how difficult it has become to cope up with the increased cost of building these new homes. Because if all the fixed price contracts have been a big problem for the builders, and if they're signing up new contracts, they're putting their margins up, which is making it difficult for the buyers to actually pay for that and afford that. So they are staying away from building new homes or new dwellings. So that is where the construction industry has been hit the most, closely followed by hospitality and accommodation. Again, accommodation and hospitality are also kind of related with the construction industry to an extent. That is the second most impacted industry in terms of liquidation across Australia in the last 12 months. So, this is again, in the nutshell, what I would suggest at this point of time. Uh, in all those regions that we have been buying for our clients, the demand just continues to rise. It is really hard to find the right property, the good property, where we were having potentially 3 or 4 offers 12 months ago. Now we have a scenario where 10, 12, 15 people are making offer on one property. So a lot of properties are selling under multi offer scenario. So which shows the demand is really high, especially under that $1.2 million price point. The demand is just outrageous. And it's not just limited to one city. It is pronounced in Brisbane, it is pronounced in good parts of Western Sydney, Southwest Sydney, where there's affordability. It is pronounced in some good pockets of Melbourne. Maybe not 15 offers in Melbourne, but you're still getting 2, 3 good offers for good pockets in desirable suburbs, desirable properties. So that's what I wanted to bring across to you. Perth has started to show signs of a bit of maturity. There are some pockets of Perth which are still worth considering if you are an investor, but not every suburb is worth buying because Perth has seen huge growth over the last 3 years. So if we were buying, let's say, in 45, 50 different suburbs in Perth 12 months ago, we are probably just buying in 7 or 9 suburbs now. It has really gone down because we still want to make sure that our clients make that capital growth and that wealth that they can create in the first 3 years so that they can jump onto the next asset much faster. So this was just in the nutshell. And I also want you to emphasize on, if you are looking to make a purchase decision, always remember the 3-year rule that I share with all my clients. That 3-year rule means that you need to be in a position to be able to forecast your own cash flow for the first 3 years after your purchase. Now, it can be your owner occupier home, it can be an investment property, it doesn't really matter. The rule works in both the cases. If you are buying your own family home, whether you're upsizing or you're buying your first family home, you should be able to figure out that for the first 3 years, your job, your income is able to support your mortgage repayments without putting pressure on your current lifestyle. You should be also able to figure out what your future commitments would look like in addition to your mortgage, like what council rates you will be paying, what kind of insurance premiums you would be paying, what kind of other costs you would be liable for. Because if you don't know that, that is where you will start regretting your decision very soon in most of the cases. Just to give you an example, buying a house in Sydney, a big house on a 500 600 square meter lot pretty much has a council rate of around $1,800, 2 grand a year, maybe 2,200, but that's about it. Buying the same house in regional Queensland, maybe for half the price, maybe you can buy that house for 600K instead of 1.2 million. As compared to Sydney, you can buy something for 600K in regional Queensland, but the council rates are actually the double. In most cases, you'll be paying around 3.5 4 grand, even sometimes 4.5 grand, just for the council rates. And because a lot of people don't know that, they think that buying something in a regional area, in a good region where it is for 600 or 700K, they can still afford it because they are only looking at the mortgage part. They are not considering their future repayments in terms of their future outflow, like their council rates, their insurance cost. So the 3-year rule essentially means that you should be crystal clear, and that's what all our clients are, because we educate them. If we are buying them for in Perth, we will educate them accordingly that what should be their outgoing looking like. If they are buying in Melbourne or in Brisbane or in New South Wales, we will educate them accordingly because we know what the council charges are, what the property managers charge, what are the insurance liabilities looking like. So please be careful. Have your cash flow plan for the first 3 years. If you have that, you will not regret your property buying decision, as long as you buy in the right area. That's very important, because not buying in the right area means you lose a lot of money, which we don't want you to be doing, right? So again, have the right information with you. That will allow you to take the right action as well. No action essentially means that you're losing out on a lot of opportunity right now. Now, again, the best segment, I'm also waiting for your questions. If you have any questions, please feel free to share. But I wanted to discuss this last thing towards the end, which is the deal of the week. Now, in this deal of the week, now this is a property, this is a chat from my client that actually happened a couple of days ago. And I thought I would just take out this chat snip from WhatsApp and share with you guys. So the client actually came to us like 2.5 years ago, where they had around $95,000, and we helped them buy an investment asset. So these are rent vested clients, which means their saving was only $95,000. They live in Sydney with their family, so they wanted to buy something in Sydney for as a family home, but they couldn't afford it. Instead of just continue to save and continue to falling behind, we suggested them to actually invest interstate as their first property. Good thing for them, they listened to the advice, and they took that 95 grand of savings and they invested that in a high growth Queensland suburb 2.5 years ago. Fast forward 2.5 years, that same asset which they bought for $412,000 is sitting at 640 grand. And how they know about it? They actually came to me and said, well, this neighboring property has come for advertisement. It's like an adjacent property to them, same land size, and even that property is a bit smaller on land. So they said this property has come for selling now, which is smaller on land, same bedroom, same bathroom, same kind of age, same kind of property features when you're looking at the photos. And that property is selling or asking for offers above 640K. So does that really mean that my property is also 640K right now? Because it should be, because my land is bigger. And I said, yes, that should be higher than that. So this 400 actually is a typo over there. That was actually, I said to them, yes, at least your property is 600K plus. So that 400 is a typo. But what I'm trying to tell you over here is that what they've essentially done, they have converted their savings of $95,000 and they have made an additional $240,000 on top of that. So that 90 grand is pretty much now 300K plus in just short 2 years. Now, whether they could have saved that amount in 2 years, I really doubt it. So that was just the deal of the week. We haven't bought it this week, of course, but this was bought a couple of years ago, and just goes to show as how the property has performed over the years. You can enjoy the same gain, same benefit. If you want to do it yourself, feel free to do it, but please make sure you take action. You don't need to come to us for that. If you're confident you can do and find deals like that where you can get the same kind of growth, go and just do it. But please take some action while the opportunities are still there. And if you want to help from our side, you want to have a chat with me, as I told you in the beginning of the call, we are taking 7 people for a complimentary strategy session with myself before 30th of November. So if you register before 30th of November, here's the QR code. I will be sitting down with you personally, where we will go through your property plan, and I will give you a plan as to how you can create wealth using property. Any questions, guys? Please shoot them over in the comments. Let us know your feedback. If you like it, let us know. If you found value, please share it with your friends, share it around with people who can benefit. Subscribe to our channel if you're on YouTube or on Facebook. Please like and share with your friends. And until next week, keep safe. I'll see you next Tuesday. Until then, have a very good night.